How to invest in S&P 500 index fund Fidelity. One common method used to measure the strength or weakness of an investment is through its rate. It is a mathematical tool for computing how much return or revenue the investment accrues during the period of investment. Let us consider a simple example. A client of a big bank enters $100 into a certificate of deposit. The rate is given as 5% per annum. Therefore, at the end of the 365-day period, the customer may expect to cash out at $105. In more detail, it is expected that the CD is continuously earning profit so that even if the customer cashes out in the middle, he or she can receive some compensation. Yet it is not true that all financial instruments have rates like CDs and savings accounts. The ones that do are best represented by government bonds, bank accounts. The rest of the universe of financial instruments such as securities, stocks, and high-yield mutual funds do not have rates. An investor who puts money into a share of stock should expect the return of a fixed sum. Again, a hypothetical investor puts $100 into buying some shares of a company. After a year period, those shares can be anywhere in value such that the investor may have even lost money. Mutual funds behave similarly to stocks, as each fund is a compilation of several kinds of stock. The return of the mutual fund will go up and down in the same way that its component stocks fluctuate. Given this information, some investors may finally understand why financial companies keep advertising mutual fund rates. Some companies even broadcast that they offer high-yield mutual funds, but the definition of high-yield mutual fund is unclear. The rates for mutual funds advertised by financial institutions is not really a rate but rather a historical rate of return. Usually mutual funds with especially strong performances will get their rates advertised. The caveat is that the rate is entirely historical and may be completely different the coming year. A historical rate is in short an expression of how well a mutual fund did in the past but not necessarily in the future. The source of fluctuations for mutual funds from year to year is derived from two reasons. One is that the underlying securities or the component securities of a mutual fund go up and down all the time depending on the fortunes of a company, the activity of the sector to which the company belongs, or to general condition of the economy as a whole. Another is that the companies included in the mutual fund sometimes pay dividends to its shareholders. In this way, mutual funds can gain value even though the stock is lackluster. Consumers of investment products such as real estate stock and GNMA mutual funds should always remember that mutual fund rates reflect the past and not the future. High-yield mutual funds and products advertised as such should be interpreted in the right way.